Francis Hunt has spent decades studying markets, not from the outside, not as a commentator, but as someone who has tracked price behavior, studied structural patterns, and built a framework for reading what markets are telling us before the majority ever sees it. And right now, Hunt is making one of the boldest calls of his career. He's not hedging. He's not saying maybe or it depends. He is saying that silver is sitting at a convergence point that has only appeared twice in modern financial history. And both times it appeared, what followed was one of the most violent, most explosive price moves in the commodity space. Not gradual, not slow, explosive. The kind of move that, if you're positioned before it, defines your financial decade. And if you're not, you spend the next several years watching from the outside, wondering how you missed it. That is the conversation we are having today on Recession Warnings. Not theoretical, not abstract, but grounded in the specific pattern Hunt has identified, the structural forces driving it, and what it realistically means for anyone who is holding silver right now or thinking about it. Let's start with what makes this moment different, because it's easy to hear silver is about to explode and dismiss it. You've probably heard versions of that before. Precious metals always have someone making a big call somewhere. But what separates Hunt's analysis from the noise is not enthusiasm, it's specificity. It's the fact that he's pointing to a defined technical and fundamental structure that has a documented historical track record. This isn't a feeling or a gut call. It's a pattern that is repeated in recognizable form, and we are sitting inside that pattern right now. The foundation of Hunt's framework is the gold to silver ratio. If you're not familiar, this ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 15 and 20 to 1. At certain points in history, that relationship tightened, meaning silver became relatively more valuable compared to gold. At other points, the ratio stretched out dramatically, meaning silver became historically cheap relative to gold. Right now, we are sitting at a ratio that is deeply extended on the historical scale. Silver is, by this measure, historically undervalued relative to its monetary counterpart. And what Hunt points out is that every time this ratio has stretched this far, it has mean reverted, not gently, violently. The snapback, when it comes, doesn't drift back slowly, it compresses rapidly, and the price of silver moves in ways that leave most observers stunned. The two prior instances Hunt references are not ancient history. The late 1970s saw silver run from single digits to nearly $50 per ounce. The 2010 to 2011 cycle saw silver go from $18 to nearly $50 in roughly 14 months. Both moves were preceded by exactly the kind of quiet, ignored, suppressed environment that we are sitting in today. Both were preceded by a stretched gold to silver ratio. Both were preceded by a period where the mainstream financial media had essentially stopped covering silver as a serious asset class. Both were preceded by a moment where the retail investor had largely forgotten that silver existed as a monetary metal. Sound familiar? Because if you've been paying attention to financial media over the last couple of years, you know that silver is barely being discussed. It's not on the cover of anything. It's not trending. It's not the asset that people are getting excited about. And according to Hunt's framework, that silence is not a warning. That silence is the signal. Now, before we go deeper into the mechanics of what Hunt sees coming, I want to pause here for a second, because there's something important to understand about why most people will miss this move, even if they hear this video, even if they understand the logic, even if they intellectually agree that the setup looks compelling. The reason most people will miss it is not a lack of information. It's a structural problem in how most people make financial decisions. They need permission. They need the price to already be moving before they feel safe getting in. They need headlines confirming that silver is hot before they allocate. And by the time those headlines exist, the move is already well underway. The early phase of a major move in any asset class is characterized by doubt, skepticism, and a lack of mainstream validation. That's not a bug, that's a feature. Because if it were obvious, if it were already validated, the price would already reflect it. The opportunity lives in the gap between what's happening and what most people haven't yet recognized is happening. Where are you watching from? Drop it in the comments below. This community spans dozens of countries, and I want to know where Recession Warnings is reaching people today. This brings us to one of the most important structural drivers that Hunt points to beyond the technical ratio analysis, and that is the industrial demand picture for silver. Here's something that doesn't get nearly enough attention in the mainstream coverage of precious metals. Silver is not just a monetary metal, it is an industrial metal with an expanding demand profile that is directly tied to some of the most powerful macro trends of our time. Solar panels require silver, electric vehicles require silver. The semiconductor and electronics industries consume silver at significant scale. And unlike gold, which is primarily stored and recycled in high percentages, silver is consumed industrially in ways that are difficult to recover and recycle efficiently. This means that as industrial demand grows, the available above-ground supply of silver does not grow proportionally. In fact, there are credible analyses suggesting that at current rates of industrial consumption, meaningful supply pressure will emerge over the coming years. Now, layer on top of that the monetary side of the equation, the fact that silver has a 5,000-year history as a store of value, the fact that it sits outside the traditional banking system, the fact that in times of currency stress and systemic financial pressure, hard assets with intrinsic utility and scarcity characteristics have historically attracted capital flows that push prices to levels most people wouldn't have considered possible during the quiet period. This is the combination that Hunt is pointing to, not just one factor, not just the ratio, not just industrial demand, the convergence of multiple structural drivers arriving at roughly the same time in a market that is still priced as though none of this is on the horizon. Let's talk about the supply side, because this is where the picture gets even more interesting. Silver mining is not a simple, infinitely scalable business. New deposits take years to develop. The grade of existing deposits has been declining over time, meaning miners are extracting more rock to produce less silver. Capital expenditure in the mining sector has been constrained, partly because silver prices have not incentivized the kind of aggressive exploration and development that would be necessary to significantly expand supply. What this creates is a situation where demand is structurally growing, supply is structurally constrained, and the price has not yet adjusted to reflect that imbalance. In economics, this kind of setup doesn't stay unresolved forever. At some point, price becomes the mechanism that clears the market. And when price begins to move in a supply-constrained, demand-expanding environment, the moves can be nonlinear. They can accelerate in ways that feel disconnected from the gradual pace of the underlying supply-demand shift. Because markets don't price and change linearly. They lurch. They gap. They make months of movement in days once the narrative shifts and capital starts flowing. Hunt is also paying close attention to the behavior of sophisticated market participants, the ones who don't announce their positions in interviews, the ones whose activity shows up in the data if you know where to look. What he observes is a pattern of quiet accumulation. Not the retail buying frenzy that characterizes the late stage of a bull market, but the kind of steady, methodical positioning that precedes major moves. The kind of behavior that says someone with serious capital and serious conviction is building exposure before the story becomes obvious to everyone else. This is the pattern he saw before the 2010 move. And he says the fingerprints look remarkably similar today. Now, nobody can tell you with certainty that history will repeat exactly. Markets are complex, and outcomes are never guaranteed. But what Hunt is saying, and what the structural data supports, is that the probability-weighted setup for silver is as favorable as he has seen it in decades. Not guaranteed. Favorable. And in investing, favorable asymmetry, where the potential upside is multiples of the potential downside, is the foundation of every great trade that ever got made. There is also a macroeconomic context that wraps around all of this, and that Recession Warnings has been covering extensively over the past year. The global financial system is under structural stress in ways that are becoming increasingly difficult to paper over. Debt levels at the sovereign level in the United States and across the developed world are at historic highs. The relationship between central banks and the currencies they manage is being questioned more openly than at any point in the post-Bretton Woods era. The BRICS bloc has been moving with intention toward reducing dollar dependency in trade settlement. Central banks globally, particularly in the emerging market world, have been accumulating gold at a pace that hasn't been seen in decades. These are not small, isolated signals. These are systemic shifts that play directly into the narrative around hard assets. And silver, sitting at the intersection of monetary value and industrial necessity, stands to benefit from that macro backdrop in ways that few other assets can claim. When currency credibility erodes, whether quickly or gradually, assets that exist outside the system tend to revalue. Silver has been that asset before. It is positioned to be that asset again. What Hunt emphasizes, and what I think is the most important takeaway from his entire framework, is that the timing of the precise trigger doesn't matter as much as people think. You do not need to know the exact day, the exact catalyst, or the exact headline that will launch the move. What you need to do is be present before that moment arrives. Because when the move starts, when the narrative shifts, when the institutional money begins flowing in earnest, and the retail crowd starts to pile on, the price adjusts with a speed that makes orderly entry nearly impossible. You end up chasing. You end up paying prices that feel uncomfortable. And the emotional pressure of watching something run without you creates decision-making conditions that are the opposite of rational. Preparation is what allows you to avoid that trap. Not prediction. Preparation. Knowing what you own, knowing why you own it, and having conviction in the structure of the opportunity before the crowd arrives to validate it. That's the edge. That's always been the edge. Let's get specific about what the numbers look like, because that's where Hunt's analysis becomes particularly striking and where most financial media coverage of silver fails to go deep enough. The The gold to silver ratio, as we discussed, has historically mean reverted from extreme readings. The current reading places silver in deeply undervalued territory relative to gold on a historical basis. If the ratio were to revert to even its long-run average, not to the tight historical levels of 15 or 16 to 1, but simply to a more normalized reading in the 40 to 50 range, the implication at current gold prices would represent a meaningful upward revaluation for silver. And if gold itself is in an uptrend, which the price action of the last several years strongly suggests, then the move in silver gets amplified. You're not just benefiting from the ratio reversion. You're benefiting from the ratio reversion on top of a rising gold price. That's the mathematical force multiplier that Hunt is pointing to when he talks about silver having an asymmetric profile. The math works in your favor from multiple directions simultaneously. Now let's add another layer that most retail investors never think about. The silver market is, by the standards of global capital markets, extremely small. The entire above-ground investment-grade silver inventory, if you were to price it at current market rates, represents a fraction of the capital sitting in U.S. equity markets, in bond markets, and real estate. What this means is that when capital flows shift even modestly towards silver, the impact on price is disproportionate. You don't need a mass movement. You don't need everyone to decide they want silver. You need a relatively small percentage of global capital to rotate toward it. The price response can be enormous. This is the leverage that exists in small, illiquid, under-owned markets. Not financial leverage in the sense of borrowed money, but structural leverage in the sense of size. A small market hit by meaningful capital flows doesn't grind higher. It launches. And right now, silver is small, it is under-owned, and it is sitting on a structural setup that Hunt believes will attract exactly that kind of capital flow. The question that most people ask at this point, and it's a fair question, is why hasn't it moved yet? If the setup is this compelling, if the ratio is this stretched, if the industrial demand picture is this strong, why is silver still sitting at levels that feel underwhelming relative to the narrative? And the honest answer is that this is exactly how every major setup looks before it resolves. The delay is not evidence that the thesis is wrong. The delay is evidence that the thesis is still forming. Markets don't move on fundamental value alone. They move when sufficient capital aligns with the narrative, and narrative formation takes time. It requires catalysts. It requires information flow to reach critical mass. The underlying structural reality can be firmly in place for an extended period before the market price reflects it. That gap between the structural reality and the price is where patient investors build positions. That gap is not a comfortable place to sit. It requires holding conviction without external validation, which is the hardest skill in investing and also the most rewarding one. Hunt also draws attention to the historical behavior of silver relative to gold during major precious metals bull markets. Silver consistently underperforms in the early phase of the move and then dramatically outperforms once the trend is established. Gold typically leads. It breaks out first, it gets the early institutional attention, and then, at a certain point in the cycle, silver catches a bid and begins to accelerate. It closes the gap with gold and then overshoots it on a percentage basis. This pattern has played out with enough consistency that it forms a key part of Hunt's timing thesis. And what he is noting right now is that gold has already been making moves. Gold has been touching new highs. Central banks have been buying. The early phase of a precious metal cycle has, by several indicators, already begun. Which means, if the historical pattern holds, silver may be sitting at the point in the cycle just before it begins to catch up, just before the outperformance phase kicks in. That is the moment that Hunt is flagging. Not after the move, not at the beginning, right at the inflection. There's a psychological dimension to this as well that Hunt addresses directly and that I think deserves serious attention. Most people who miss major market moves don't miss them because they lacked access to information. They miss them because they couldn't hold the position psychologically. They got in, they watched the price do nothing for months, they grew impatient, they questioned their thesis, they sold at a small loss or a small gain, and then they watched the asset do exactly what they originally expected it to do, but without them on board. This is one of the most common and most painful experiences in investing, and it's entirely psychological. The trade was right, the timing was roughly right, but the emotional endurance wasn't there to see it through. This is why Hunt emphasizes the mental framework as much as the technical and fundamental setup. Because the most sophisticated analysis in the world is useless if you can't hold the position through the periods of doubt and quiet. The setup being real doesn't guarantee you will benefit from it. Your ability to hold through the uncomfortable middle phase is what determines whether you actually capture the move when it comes. Building that kind of conviction requires understanding what you own and why. It requires having done the work, not just heard someone else's conclusion, but actually traced the logic, understood the drivers, and internalized the thesis at a level where external noise can't shake you off your position. When you understand why silver sits where it sits in the global monetary and industrial system, when you understand the historical precedent for what happens when the ratio reverts, when you understand the supply constraints and the demand growth vectors, you don't need constant reassurance that you're doing the right thing. The logic holds. And the logic becomes your anchor when sentiment gets difficult and when the mainstream narrative is still pointing somewhere else entirely. Let's talk about what a realistic positioning framework looks like. Because one of the things that frustrates me about most precious metals content is that it tells you why to own silver without ever getting concrete about how to think about actually building the position. Hunt's approach is not to go all in at a single point. It's to build systematically during the accumulation phase, while the asset is still quiet, while the narrative hasn't yet formed, and while the price still reflects the current reality rather than the anticipated one. This means taking regular measured allocations rather than trying to time a perfect single entry. It means treating the accumulation phase as an ongoing process rather than a single decision event. And it means sizing the position in a way that you can hold through volatility without it creating panic, because even the most compelling asymmetric setup will have periods of drawdown, periods of sideways movement, and periods where the thesis looks questionable to outside observers. Your position size should reflect your conviction and your time horizon, not your excitement about the thesis in any given week. Physical silver, allocated and stored securely, remains the most direct expression of the thesis. There are no counterparty risks embedded in physical metal. There's no leverage, no expiry, no structure that can go wrong in ways you didn't anticipate. You own the asset outright. The trade-offs are liquidity and storage, both of which are manageable. Silver ETFs offer easier liquidity and lower friction for people who prefer a more accessible vehicle, though they carry their own set of considerations around counterparty exposure and the way they track spot prices. Mining equities offer leveraged exposure to the silver price, but introduce company-specific risk, operational risk, and the full volatility of the equity market on top of the commodity volatility. Hunt's framework doesn't prescribe a single vehicle. It prescribes a positioning philosophy and leaves the implementation to individual circumstances, risk tolerance, and investment timeline. What matters is that you have meaningful exposure before the move happens, not the perfect vehicle for that exposure. The macroeconomic environment that Recession Warnings has been tracking makes this setup even more compelling when you zoom out. We are navigating a period of elevated government debt, structurally higher interest rate pressures compared to the prior decade, ongoing geopolitical fragmentation, and a quiet but persistent erosion of confidence in the institutional frameworks that have governed global finance since the 1970s. These are not overnight developments. They are slow-moving structural shifts that accumulate pressure over years and then release that pressure in compressed timeframes. Hard assets, and silver specifically, have historically served as the release valve for that kind of accumulated systemic pressure. Not because of any mystical quality, but because they exist outside the system, cannot be printed, cannot be diluted, and carry centuries of human consensus about their value. When trust in the system frays, assets outside the system attract flows. We are in an environment where that fraying is accelerating, not reversing. None of this means that the path will be straight or that every week will show upward price movement. It means that the structural forces converging around silver are, in Hunt's assessment, and in the assessment of a growing number of serious macro investors, creating a setup where the odds are unusually favorable over a multi-year horizon. The question that Hunt ultimately leaves people with is not whether silver will move. He's fairly settled on that in his own analysis. The question is about participation, whether the people watching and the people who understand the thesis, people who can see what he sees in the data, will actually be positioned to benefit when the move arrives, or whether they'll be in the position that most people find themselves in after every major market move, which is understanding exactly what happened in retrospect, while having missed the actual opportunity in real time. This is the distinction between financial consumption and financial action. Consuming information about silver, watching videos, reading analyses, following the discussion, that's not the same as being positioned. Being positioned means you've allocated, you've built exposure. You've committed capital to the thesis in a way that translates the intellectual understanding into an actual financial outcome. And the gap between consumption and action is where most of the missed opportunity lives, because information without action produces no result. Understanding without execution produces no result. The insight is only valuable when it's paired with a decision, and the decision is only valuable when it's made before the opportunity fully reveals itself to everyone. That is the moment Hunt is pointing to. That is what Recession Warnings is here to help you see clearly, and the next move is yours to make. If this breakdown gave you clarity on what's happening in the silver market right now, hit that like button and make sure you're subscribed to Recession Warnings, because we go this deep on every major macro shift before it becomes mainstream news. Share this with someone in your circle who needs to hear this before the window closes. Because the ones who understand early are the ones who are positioned right. And the ones who are positioned right are the ones who come out of what's coming in a fundamentally different place than those who waited for certainty that never came.